Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's guests are the ADMIS Research Team of Mark Bowman, Mark Soderberg, and JP Steiner. Starting with the grains, Mark Soderberg, how has the recent cold snap impacted U.S. winter crops?
Well, I would say the answer to that is it certainly had some impact. However, the extent of the damage will likely not be revealed for weeks, if not months, once the winter wheat crop breaks dormancy. Well, I think our largest winter wheat producing state of Kansas likely avoided significant damage as they received a 2 to 3 inch blanket of snow on Friday into Saturday. This insulated their crop from the sub-zero temperatures over the weekend. However, areas in the central and northwestern plains were not so fortunate. Much of Nebraska, central and southwestern South Dakota, along with Montana, had little to no protective snow cover, and with weekend temperatures falling to as much as 20 degrees below zero in some of these areas, the crop will undoubtedly have suffered some freeze burn. Even areas of Missouri, along with central Illinois and Indiana, they saw temperatures plunge to nearly 10 degrees below zero late last week ahead of the snowstorm on Friday night and Saturday. So there too, I think we probably experienced a little bit of potential damage as well. The weekend weather wasn't all bad news, however, as moisture from the winter storm will certainly help ease drought conditions across the southeastern plains and southern Midwest ahead of the storm. U.S. winter wheat areas in drought had increased to 42%. It's nearing the 52-week high of 45%, so I look for some easing in drought readings here with this week's update. Prices are scaling back a little bit this morning, giving back a chunk of Friday's price surge, and until more is known of the U.S. winter crop, I think that further upside price appreciation is probably going to be limited with the improved moisture and with the elevated global supplies.
All right, can you share with us a quick weather update from South America?
Sure. For the past several weeks, there has been lingering dryness and more recently, much above normal temperatures across southern Argentina. I think that combined with China fulfilling their commitment to buy 12 million metric tons of U.S. soybeans has enabled soybeans to bounce back to the highest levels in a month. This past weekend, however, I'd argue that the rains across key areas of Argentina, the northern La Pampa area, southern Cordoba, and western Buenos Aires were better than expected and provided some much needed relief there. And forecasts moving forward are starting to trend a little bit wetter. So I think that's contributed to the price pullback we're seeing this morning. In Brazil, much of the growing season has been, for the most part, stress-free. Recent dryness in the deep south has pretty much been limited to Rio Grande do Sul, and they're likely to see some scattered showers later this week, providing some limited relief at least. But they're going to need follow-up rains here in February to help improve crop prospects there. Harvest in the north is starting to accelerate. Mato Grosso, their largest producing state, harvest there has doubled in the past week to 14%. The country as a whole sits at 5%, slightly ahead of its historical average. And in corn, 5% is a magic number there. The first crop harvest has reached 5%, while the second crop plantings also rests at 5%.
Thanks, Mark. Moving over to Mark Bowman. What does this past weekend's cold weather mean for the U.S. gas supply?
Well, and by the behavior of the market, traders view this week's turnabout in the weather as probably a game changer for U.S. supply. As of January 16th, which was last week's storage report, U.S. supply was running 8.8% above a year ago and 5.5% above the 5-year average. And that certainly looks to change this week. The weather has been trending mild up to this point. Now, a year ago, supply was running about 1.3% above the previous year and 2.3% above the 5-year average around this time. And we had some more seasonable cold weather arrive last year. That helped increased the pace of the weekly draws to ahead of average. So by early March last year, supply was a full 27% below previous year and 11.3% below the 5-year average. Supply fell from 2,890 or 2.892 billion cubic feet trillion. Let me back that up. Supply fell from 2.892 trillion cubic feet on January 17th to 1.698 trillion by March 7th. That's a decline of 1.194 trillion. And a similar decline this year would put storage, if we saw a similar decline this year, it would put storage still up about 10% from a year ago and 1.4% above the 5-year average. We have that much more storage now. So it might be kind of a lot to ask to see such a dramatic drop. Now, the thing is, production has dropped off sharply with the arrival of the storm. As of Friday, daily production was 105 billion 434 million cubic feet, and it fell to 92 billion 540 million on January 25th, 2 days later, Sunday. And that's the lowest for this date since 2022. We had an all-time high of 111 billion in December, and we were hovering around that. These are daily numbers, and this is dry gas, and hovering around 110 billion earlier this month. So this is a lot of a substantial supply this week that's going to have to be made up pretty quickly. We've had concerns about freeze-offs at wells, and we kind of need the weather to move on and get less severe pretty quickly.
All right, Mark, thanks. Let's move over to the sauce. How is the Brazilian coffee crop shaping up?
So we're starting to see the early forecasts for 26-27 come in, and they are consistent in calling for higher numbers this year. That's not a big surprise. Arabica is coming off it's coming into the on year of its biennial cycle, and the weather has been decent. We had last week coffee trading firm Sucden projecting 72.5 million bags of total coffee production for this year, which would be up from 64 million in 25-26. That's an 8.5 million increase. They look for Arabica production to reach 47.5 million, up from 39 million last year. They look for Robusta to stay unchanged around 25 million. And last November, Saffron Mercado, the consultancy, put production at 71 million bags, so not quite as high as Sucden's, and that would be up from 64.25 million last year, with again 46.7 million for Arabica and 24.3 million for Robusta. The weather in Brazil continues to look favorable. Growing areas seeing generally good rain events, but the growers still stress the season has a long way to go. We have harvest should begin in April or May.
Thank you. Moving over to JP, what has been going on with the yen recently?
Yeah, there's been a lot of speculation recently about a possible intervention on the yen from Japanese authorities, just given how the yen has sank against the dollar and other major currencies in recent months. The yen's dropped to the 160 level against the dollar multiple times over the recent months, as the stubbornly weak currency has been under pressure ever since the election of Prime Minister Takeshi. Now, that's not really a news story by any means, and the catalyst to the yen's decline in recent weeks have been well documented. But essentially, Takeshi's pro-stimulus policies, paired with her desires to lower taxes, has raised scrutiny in the Japanese bond market, leading to record high yields and also causing investors to ditch the yen. Intervention from authorities was always on the table and in market speak, but it wasn't until Friday when things really began to become more solidified. The yen experienced a large spike in early trading Friday, known as a rate check, which is essentially when a government authority or institution asks market participants for pricing on an asset, and is also usually seen as a precursor to intervention. Friday's rate check was made by the request of the U.S. Treasury and conducted by the New York Fed. The Fed's actions on Friday was the strongest signal so far to date that the Japanese and U.S. authorities are working closely together to stem the currency's decline, keeping markets on high alert for intervention. Now, just because there was a rate check does not mean that there is any imminent action pending from authorities. And the move alone was enough to see the yen stabilize just below the 154 yen per dollar level. That's well below the 160 level we've seen and sort of been called the line in the sand. But still, the big question for markets is whether a joint U.S.-Japan intervention is imminent. And it has been quite some time since the U.S. and Japan have conducted something like that. The last time the U.S. helped the yen out was back in 2011. Now, the U.S. It doesn't have the most compelling reason to engage in coordinated action. The U.S. likely doesn't want to buy the yen since it's generally been declining or depreciating over the last 5 years. And Japan would also need to sell a portion of their U.S. Treasury holdings if it were to conduct a sustained yen buying operation. That's certainly not a situation the U.S. government will want to happen given the recent volatility in the bond market. So Friday's move is supportive of the currency and so far enough to keep markets on their toes for possible intervention. But more than anything, it shows that there is a realistic possibility of intervention from authorities after weeks, almost months of speculation.
Great. And lastly, what can we expect from the Fed's meeting this week?
Yes, so the Fed is set to announce its policy decision Wednesday. The bank is likely to stay on hold on rates. Recent data has been supportive to holding rates. We have seen the unemployment rate fall back to 4.4%. The JOLTS data has shown no signs of immediate or extreme stress in the labor market. And weekly jobless claims data has also been pointing to the positive side as well. Now, the labor market is definitely cooling, especially in comparison to years past. And most hiring that was made in 2025 was thanks to the healthcare sector, which tends to hire regardless of economic conditions. Now, looking to the other side of the mandate, inflation still rests well above the Fed's 2% target. The most recent PCE data we got showed that prices rose 2.8% year over year in November, while December's CPI data showed a 2.7% rise in prices, matching November's figure. The last time inflation was actually at or near the Fed's target was February 2021, almost 5 years ago, when annual inflation held at 1.7%. Anyways, looking at the macro landscape right now, economic growth in the country has so far been surpassing expectations. Q3 GDP was recently revised higher to 4.4%. That surprised to the upside and also calmed fears of an economic downturn. These dynamics certainly have bought members at the Fed more time to wait and see how economic data continues to unfold, which leads me to expect that Fed Chair Powell will emphasize that future policy moves will depend on how economic data evolves. Looking ahead, markets right now only priced for a July rate cut from the bank and no further rate cuts in 2026, after initially starting the year priced in for 2 at just over 50 basis points of easing. So focus at this meeting, in my opinion, should be paid to the number of descending votes for clues on the timing of the next rate cut. The more policymakers that are on board with holding rates right now is likely to continue to maintain that stance if economic data evolves the way that it has been recently. Now, that is a big if, and data the economy has been seeing recently has been showing that the economy has been performing better than expected, and especially over the last year. But there still could be some surprises waiting for us. But I really don't see anything of that nature coming when looking at recent labor market data. So long story short, expect the Fed to kick the can farther down the road.
All right, thanks, JP, and thank you all. Remember, the views and opinions expressed today on this video are solely those of our guest speakers and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.